Okay, and welcome back, students who are taking financial accounting, and we're continuing in the series for chapter 1, the short exercises, and we left off with 1-6 in the last one, so we're going to pick up with 1-7. And remember, you can pause the video and watch it again, and if you still don't understand something, you feel free to contact an instructor. Okay, so it says here, Quick Care Clinic started a business when Dr. Ham purchased $15,000 of common stock in the business for cash. Now notice this is Inc., Quick Care Clinic Inc. Okay, so because it's incorporated, that means the ownership would be through common stock, or through shares of stock. Not just common, but in the future you'll learn about preferred stock also. Right? So he purchases 15,000, and by the way, incorporated isn't a business entity, a corporation. And in order to start that up, that's how you would invest your cash in the business, by purchasing stock. Right? So that's what he's doing here. He purchases $15,000 of common stock. So the common stock is equity, okay? And in the business for cash. So what has happened is right here at this point in time, up to this point. Now remember, I said it's about understanding and application, not just comprehension. I mean, I could, as I was going along and I'm reading this, oh yeah, he purchases 15,000 of common stock in the business for cash, but what does that really mean? Okay, well, what happened is the understanding of it is a transaction occurred at that moment in time, and this is something you keep in the back of your head when you're reading. Okay, when you're trying to think through these things, you're bringing all of the body of knowledge that you have to the table. You slow down when you read, and you think about what you read, and you're constantly asking questions in the back of your mind, and you're bringing the knowledge that's in the back of your mind to the forefront. So at this point in time, before I go further, realize that even though you're bringing this body of knowledge, doesn't mean you're using it all. You're picking and choosing that knowledge to meet the situation. Okay, so here, he purchases $15,000 of common stock in the business for cash. Okay, well, that's a transaction in the business. Okay, a transaction in the business is an event that happens in the business, right? And when you have a transaction, there's always two sides, right? Because you're going to have to make a journal entry. You're going to have a debit and you're going to have a credit. So if I had to make a journal entry for that transaction, if you recall from the intro videos that I had made, okay, when I'm making a journal entry, the first question that I ask myself is, am I affecting cash? In this case here, he's buying common stock and he's using cash, okay? So if he's using cash, cash is an asset, right? What's the normal balance of an asset? The normal balance of an asset is a debit, meaning that's what increases that category of account. So we increase our assets on the debit side. And since cash is an asset and we're increasing our asset, cash started out at zero. Okay, now the business has $15,000 in cash because that's what Dr. Ham is giving to the business in return for common stock. Okay, so the common stock goes from zero and that increases to 15,000 also. Okay, but on the cash side here, right? Cash is an asset. We increase our assets on the debit side, so cash, we debit cash for 15,000. Now, when I'm making a journal entry, I know my debits must equal my credits. So if I debit cash, that means I have to credit something else for 15,000. The question is what? Well, what is happening in this transaction? Common stock, right? Common stock is equity, okay? Common stock is equity, okay? And remember that equity, right? The normal balance of equity is a credit, right? The category of accounts is equity, and the normal balance of equity is a credit. Why? Assets equals liabilities plus equity, right? If the asset is the normal balance is a debit, and that equals, then these both have to be credits, right? So we know we have to credit the equity account. Well, he's purchasing common stock, so we look under the equity and we see that we have a common stock account, and we know that it has to be credited, right? In the amount of $15,000. I mean, I just explained this to you, okay? And I was just explaining this to you, right? But in reality is I don't have to explain that, okay? That is what's going on, the underlying principle of it, okay? If you know that that you have a debit to cash and debits have to equal credits, then all you need to do is just look at your chart of accounts, okay? And you look under the category of account, whether it's an asset, a liability, equity, revenue, or an expense account, right? And you say, well, is this cash buying an asset? No, it's not something we're going to own, right? Common stock is not what the business owns. Right? Is it a liability? No. Is it revenue? Was not a sale, and it's not an expense because it's not part of the operation of the business, so it has to be an equity account. And then all I need to do is look under the equity accounts and see what general ledger accounts there are, and choose the right one, which in this case here is common stock. This is called backing into information. Okay. So I'm going to back into that information, and that makes my journal entry correct because I'm just applying this thought process the correct way. Sure, there's a reason, there is a reasoning and there's underlying fundamentals as to why I'm choosing common stock, but do I really have to know those? It's good that you know them, okay? But when you're at a loss for, as part of a thought process, you can always just back into that information. Okay. So that is all that, all of that went into my head, okay, just by reading up to this point in time. Okay, that's all in the back of my head here, right? I just put it down on paper. Now, before starting operations, Quick Hair Clinic Inc. borrowed $18,000 in cash by signing a note payable to First National Bank. Now, if I'm borrowing $18,000 in cash, that's another transaction. Okay, so I have a debit and I have a credit. And again, I'm asking myself the question, am I affecting cash? Okay, and the answer is yes. Okay, well, if I'm affecting cash, right, my cash, up to this point in time, actually it would be 15,000, but as a basis, I can just say, it was zero, and now I'm getting $18,000 more because I'm borrowing it, right? So that means my cash is increasing, right? It doesn't matter whether this is 0 or this is 15, I'm getting $18,000 more, okay? So my cash is increasing. Well, just like in the previous transaction, cash is an asset. Assets increase on the debit side, so I'm going to debit my cash for 18,000, right? Well, at this moment in the thought process, debits have to equal credits, so that means I have to credit something else for 18,000. What? Okay, I look at my categories: assets, liabilities, equity, revenue, and expenses. Okay. It says here, by signing a note payable. Well, when you see the word payable, immediately you should be thinking liability. So I would look at my liability accounts, ledger accounts, and then I would choose the proper account. In this case here, you should have a note payable account underneath your liabilities. Okay, we know it's not an asset because we're borrowing. Okay, we're going to owe that money back. It's not something we own. We know it's not equity because it's not an investment in the business, and it's certainly not part of the operation of the business, so it has to be a liability account. Okay. All right, so that's where I'm at that point in time. So that's where I'm at right there. And this is all what's going on in the back of my head. Okay. Now, granted, I do it quicker because I've been doing it for a lot longer than you, but that's what's going on in the back of my head. Okay. Now it says account for these two transactions in the accounting equation. Okay. So let me squeeze this in here. So in the accounting equation, I have assets is equal to liabilities plus equity. Okay. All right, so what we're doing here is basically we're, when it says account for these two transactions in the accounting equation, if I were making journal entries, I would have put these two transactions into the journal. Now, when we put information in the journal, we post them to the general ledger accounts, right? So this here is like putting the information in the journals. But now we're being asked to post this information into the general ledger accounts. And when we do that, what we're doing is we're rearranging information. We're rearranging the information so that we're creating accounts that have like information together, meaning, here I have under assets, I have these accounts. Well, one of them happens to be cash. So I'm taking the 15,000 and I'm putting it into the cash account under assets. Okay. I'm going to take this here 15,000 for common stock, and I know that's an equity account, so I'm putting it under the equity account, a category of equity in the common stock account. So I just rearrange that information because I'm grouping like information together. I'm grouping all the cash together. I'm grouping all of the common stock together. That's what's called posting to your general ledger accounts. So my next part of the transaction is this here 18,000, which again goes under the cash. Okay, and then I have a notes payable, which goes under the liability. So now when I do the math, right, and the math is like creating the balances in the accounts. Okay, and once I have those balances in the accounts, I then can create a general ledger trial balance. But that's beyond the scope of this exercise, so we're not going to go there just yet. That's for another chapter. So under assets, we have 33,000, and that's equal to 18,000 plus 15,000. Okay, so my accounting equation is in balance. 33,000 is equal to 18,000 plus 15,000. Okay. Now, if you had looked in at the answers, you'll see something similar to what I just, I have on the screen here. Okay. I mean, obviously you don't see these journal entries, but remember that was what I was thinking about while I was reading the problem. And this portion here is kind of like what you see, in the answers. Now realize that as we go forward, and I'm just bringing it up here because it came into my mind, and I'm going to stop this video in a moment or two. All the concepts are the same, but how it looks on paper can be somewhat different. Okay, I did this in a format that was horizontal going across the page. Okay, I could have also done this in a format that was vertical going up and down the page. Okay, as you can see by the solution, I believe it said investment and borrowing, where I actually put cash, and then this should have been note payable, and I would have wrote common stock here. Okay, basically the same information is there. It just looks slightly different. So as long as you understand the concepts, you can decipher the information. All right. So don't be surprised that what I put on the screen at times might not look exactly like what the answer looks like. Okay, because I am just working out of my head. I wasn't referring to the answer. I just happened to look down and see that it had investment and borrowing on there, and then it occurred to me, oh well, all of the concepts apply. I put the information there, but it can look slightly different. Okay, so with that said, I'm done with 1-7, and I'll see you with 1-8 in the next video.